Do you want to learn the most important concept in finance? This concept has made Warren Buffett one of the greatest investors in human history. It's used by every multi-billionaire hedge fund manager around the world. I'm going to show you how you can use it today to start building wealth. My name's Ken Freeman. I'm a CFA charter holder, a professor of finance, and I help people just like you get jobs on Wall Street. Let's rock. What exactly is this concept and what exactly does it symbolize? This concept is called time value of money. What it means very simply is $1 today is worth more than $1 in the future. Okay, let's use a simple example here. Let's say we have a rate of 10%. I could take that $1 today, invest it for 1 year, and have $1.10 a year from now. Alternatively, I could take that $1 a year from now, discount it back to today by taking $1 divided by 1 plus 10%, and I would have 91 cents today. So if you look at it in either way that makes sense to you, $1 is greater than 91, 110 is greater than $1 today worth more than $1 in the future. This fundamental concept is the underpinning of everything in finance because finance is forward looking. It focuses on the future, whereas accounting is backwards looking. Now, some of you might be saying, all right, Ken, that's cool, but where'd you get that 10% from? So I'm glad you asked. That 10% is the combination of two pieces. One is the risk-free rate. The risk-free rate is going to be two components, the real risk-free rate and inflation. Now, I know everybody goes bananas, inflation, 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 but people don't understand what it is. Very simply, inflation as a concept is looking at the price of a basket of goods a year ago versus those same basket of goods today. Now, inflation is not something to be scared about. At the end of the day, inflation is going to be increasing slowly over time. That's a good thing because ultimately it symbolizes that we're growing as an economy. People get paid more, things are going to cost more. It all makes sense. Let's look at two different companies and what their rates are. So let's take Verizon, basically a maker of telecommunications services such as your cable bill or your cell phone bill, and Tesla. All right, Tesla, obviously we know the EV giant rock star company, Elon Musk controversy, blah, blah, blah. But if you look at the rates of return of both of those, you would have about 6% for Verizon and 11% for Tesla. Now, most of you look at that and you say, oh, it's a difference of 5%, but you got to dig a little bit deeper. Remember I said there's two components to this rate. It's the risk-free rate, and then it's also a spread. So let's think about this for a second. The risk-free rate's approximately 5%. So if we take the 6% for Verizon and we subtract 5%, that means a risk or a spread of 1%. If we do the same thing for Tesla, we have 11% minus 5%, that's 6%. What that means is there's a 6% spread or risk that gets added to the risk-free rate for Tesla versus 1% for Verizon. That means Tesla is 6 times riskier than Verizon. Now, that also means more risk, more return. So if you invest in Tesla, you're going to get a better return than Verizon, but there's more risk. So it also could go down. And that's that volatility concept that we also have to consider here, because volatility, you can win, you can lose. But just remember in finance, without risk, there's no reward. So one of the things that brings us to is a concept that Warren Buffett talks about, which is don't lose money. Rule number 2, don't forget rule number 1. So how do we tie all of this stuff together? Well, there's a really cool rule that is used in the world of finance that Warren Buffett uses and hedge fund managers use to try to figure all this out. And it's called the rule of 72. You take 72 divided by a rate of return, and that tells us how long it takes to double. So Warren Buffett, as a case in point, wants to generate a 7% return year over year. What that means is he ultimately wants his money to double every 10 years. Now, you might be thinking, well, Ken, that's not that much return. 7%, that's not really high. But you have to remember, Warren Buffett is investing hundreds of billions of dollars. So he can't invest in some small company. It's just not going to have an impact to his bottom line. If you have Verizon with that 6% return, 72 divided by 6, that's 12. That means Verizon would double in 12 years. But let's take a look at Tesla. 72 divided by 11, that's 6.5. So that means it's going to double in 6.5 and then double again in 13. You're going to get 4x from Tesla versus 2x for Verizon over the same time frame. Pretty crazy. So what are we going to do with that rule of 72 and how do we apply it to our own lives? Now, before we get into that, we have to think to ourselves, what would we want to generate? So if you think about it, we would want to generate a good solid return. So the question is, what is a good solid return? Well, there's a benchmark that all hedge fund managers and money managers are judged against. That benchmark is called the market. You're like, okay, what's the market? Typically, the market is going to be referred to as the S&P 500. It's the 500 most well-known, largest companies in the United States of America. Now, here's the catch. 98% of money managers underperform the market over a 10-year period. So that means you could actually beat 98% of money managers, people who do this for a living professionally, just by investing in the market. So I know you're like, whoa, dude, whoa, tell me more, tell me more. All right, so check this out. The average return, total return of the S&P 500 over the last 100 years is about 10%. When I say total return, that means price as well as dividends. If we talk about the rule of 72, 72 divided by 10 means we're going to double every 7 years. That's awesome. So now, how do we implement this? What do we do? Well, it brings me back to our old friend Warren Buffett and a really cool story. Every year they have an annual meeting. It's known as the Woodstock for Capitalists out in Omaha. Basically what happens is people who've invested in their company, Berkshire Hathaway, go out to Omaha and they ask questions of Warren Buffett and his partner, Charlie Munger. One time, one of the student attendees went up to the microphone and said, I want to become a millionaire. How do I do it? Now he's all jacked up, figuring he's going to get the answer, what school to go to, what to study, where to work, and all this stuff. And Charlie Munger responded as follows. He said, that's pretty easy. Maximize your retirement contribution, dollar cost average into the S&P 500. You can't help but be a millionaire. The kid was kind of crestfallen. He was like, that's it? He was like, yep, that's it. Probably should have asked how to be a billionaire. So ultimately, what does that all mean? First, we have to say, what is the maximum retirement contribution? So for an IRA, it's $6,500 in 2023. For a 401k, it's $22,500 in 2023. So if you were to maximize an IRA contribution and get that 10% market return, that means that you would end up with $1 million in a little more than 29 years. What if, on the other hand, you did it with a 401k, that $22,500 every year? Well, it obviously would be a lot faster. In that case, it would be just under 18 years. So how can you actually do this in your own real life? What you would do is you would invest in VOO. That's the ticker symbol for the S&P 500 total return through Vanguard. It's the cheapest way to get into it, and it's something that I actually do myself. Now, what you're going to do is dollar cost average. What does that mean? You just always put a little bit in every 2 weeks. And what's going to happen is you're going to catch the highs, you're going to catch the lows. But guess what? If you look at the market, it goes up and to the right. So let's wrap this up. We talked about Warren Buffett and his application of time value of money. We talked about the rule of 72, which is how long it takes to double. We talked about hedge fund managers and how we could actually beat 98% of them just by investing in the market. And talked about how we can actually do it on our own and institute this awesome concept in finance in our own lives so that we can start building wealth today. If you like this video, please smash the like button. Also, don't forget to subscribe for more awesome content. And please throw some comments below. I want to know what you think about this video. And if you have other ideas that you want me to talk about, don't hesitate to pop it in there. Be relentless.